China, as you know, is the fastest growing automotive market in the world. When you look at the emerging markets, specifically Brazil, Russia, India, and China, it's projected that roughly over the next 5 years, 50% of the entire growth will come from those four markets. China represents about a third of that. It's estimated that by 2020, it's a fair way off, that 40% of the luxury markets, 40% of the sales of luxury automobiles will be in China. So we are moving to a different mix here over time.
A year from now, General Motors plans to be making 100,000 Cadillacs in China. How many will you sell here in China, and where will you export the extras?
Well, we think we can sell them all here, and obviously we won't get to 100,000 in the first year. We'll build our volume up, but we're quite confident that Cadillac, we have been selling Cadillacs here for a while. They're largely imported, but we know there's a demand.
GM just agreed to jointly develop an electric car with your Chinese partners, but General Motors already has an electric car, the Chevy Volt. Why exactly didn't you share the Volt with your Chinese partners?
Well, let me be perfectly clear. We've never been pressured in any way to sell it here. It's a different car for a different market. So if we brought it here, and we will, but it'll be on an import basis to China. And as a result, it doesn't qualify for any special handling, any special credit of any nature.
Do you think that's against WTO rules?
I don't know. I'm not a lawyer, but I know what we've decided to test market it here, and we'll make decisions further down the road with regard to the Volt.
How comfortable are you with sharing technology with your Chinese partners? High technology, latest technology?
Well, you have to understand, we've been here 15 years. We're in 10 odd different joint ventures and development programs. And we do cede our intellectual property here when we feel it's in the best interest of our partnership.
But it wasn't in the best interest to share the Chevy Volt technology.
We developed the Volt specifically for a North American market. Understand, roughly 80% of Americans drive 40 miles or less per day. But there are long interstates, and we wanted the flexibility of having virtually unlimited range, no range anxiety with the Volt. And we'll see where it goes. As I said, we are going to export to this market, and we export to a lot of markets, and then we'll see exactly where that shakes out. We may one day bring the Volt and manufacture it here, but at this point in time we're undecided. I can assure you with some degree of certainty that Chrysler would have gone down, and tens of thousands of workers that support the automotive industry, people that make ball bearings, tires, glass, the automotive dealers around the country would have been in huge jeopardy. Had the supply chain gone down, it's estimated that maybe even Ford would have gone down. That's basic and core, the basic industrial infrastructure of the United States would have been at risk. The hope, I think, of the American public, I was a taxpayer, not associated with General Motors then, was, do we want the industrial base? Are these jobs important? Is it part of the social network of the United States? Yes. There are lots of points of view around the table on the subject. I would argue from a pragmatic point of view, it was a good decision by two administrations, both the Bush and the Obama administration.
The last time there was a global economic slowdown, GM went bankrupt, and growth is slowing again. What are you doing to make sure American taxpayers aren't asked to bail GM out twice?
Fair point. At the low point of the financial crisis, car volumes primarily in U.S. dropped from 16+ million in sales to in the 9 to 10 million unit range. Coming out of bankruptcy, we lowered our break-even point through the restructuring to the point where we were actually not only making money but producing cash. So unless it goes to a greater than 40-year all-time low, we should be in pretty good shape. So I'm reasonably confident that we're in good shape from a cost perspective, and then it goes from there. You know, at the end of the day, you win with the best products.
And do you have enough cash to get through a downturn?
Prior to the bankruptcy, we had over $40 billion in debt and essentially limited to almost no cash. Today we have minimal debt and about $34–35 billion in cash and a $5 billion revolving line of credit. I would argue that we are probably in the best shape, the best fighting trim, if you will, that we've been in since probably the 1960s.